Bhavna, we are live now. Kindly start with the introduction.
Okay, ma'am. A very good afternoon to all the participants. I am CMA Bhavna Yadav from Tax Research Department. I welcome you all to our webinar today on topic revision under section 263 and 264 of Income Tax Act. Our guest facilitator for the session is Nilay Baran Som sir, who has agreed generously to share his expertise with us. Sir has joined Income Tax Department in the year 1990 and served in various roles like assessment charge, TDS, international taxation and training. He worked on deputation to the Department of Taxes, governments of Botswana from 2002 to 2005 and contributed to Taxpayer Information Series Booklet 44 published by CBDT on royalty and technical services. He has also contributed in developing resource for non-residents and published several articles in the departmental e-magazine Taxilog. He has been posted as training faculty in Direct Taxes Regional Training Institute, Kolkata, and conducted session at NADT, Nagpur, and Regional Institute at Chennai, Lucknow, and Bangalore. Sir has retired as Commissioner of Income Tax, Departmental Representative 1, IT80 Chennai, on 31st Jan, leaving behind legacy of knowledge and service. We have honored to have him with us today. Over to you, sir.
Good afternoon, everybody. I'm thankful to Bhavna for saying kind words about me. And I think it's a great privilege for me to share my experience and knowledge with professionals of standing from the CMA Institute. I understand the audience today comprise of professionals who are practicing. Some of you are practicing income tax. Some of you are practicing only cost accountancy and auditing, and some of you are maybe practicing both income tax and cost accountancy, and some of you are working for organizations looking after their tax matters as internal resource persons or managers. So for any speaker, this is a formidable audience, and I had so many years working in the department. So basically, I was a tax administrator, and towards the end, I was posted both as Commissioner Appeal and also as Commissioner DR, CIT DR in ITIT. So that gives me the advantage of having both sides, the departmental view and the views from the assessees or the taxpayers. Both the views where I was enriched by both the views. So, and I know many of you are practicing, and some of you are working for your organizations. So there is no point in going by section verbatim. On the other hand, better I will show you certain slides and try to flag certain issues and post some fine prints of the sections 263 and 264. Basically, I'll be covering the session. First, I start with the 263 and 264 basics. Then I will go to 263. Then I will go to 264. After that, I will refer to certain case laws, particularly as some of you are practicing or working for the interest of your organization. I definitely have the taxpayer perspective so that I can provide you or acquaint you or refresh your memories of certain landmark cases which may be of professional help to you. So, and let us make a pact, all of us who are in this seminar, we are keeping our mobile phones in silent mode. Is it okay? So I don't know the number, how many of you have joined. So yesterday we had a talk with Priyanka ma'am, and I was told that it is an all India level. So lot of participants will be there, and definitely I am overwhelmed at it. It is an all India presentation that way. So first we start with the basics. If we look at the slide and the bullets therein, section 263 and 264, they are at the two ends of the continuum, two ends of the spectrum. While 263 is revision of orders prejudicial to revenue, and 264, although the section head is revision of other orders. Basically, 264 is an assessee friendly section. It is revision in favor of the taxpayer, so to say. Whereas section 263 is basically a remedial measure available with the commissioners or principal commissioners, so that any mistake committed by the lower functionaries, maybe ITO, maybe assistant commissioner, maybe deputy commissioner, or even joint commissioner or additional commissioner, sometimes they are given charges of assessment. If any error is committed by them causing prejudice to the revenue, loss of revenue, then there are certain remedial measures inbuilt in the statute. Of them, 263 is on the topmost rank. So I go to the slides again. Next slide. Before going to the next slide, if you see the bullets, section 263 will discuss revision of orders prejudicial to revenue. And on that, who are the authority who passes this 263 order? What is its aim? Aim I have already discussed. Aim is to make good for the loss to revenue that might have been caused by the action of the junior officers. On the other hand, for 264 also, there must be some authority who is passing 264 order, and the aim is to pass an order which is not prejudicial to the taxpayer. I hope I am audible to all of you. And regarding this presentation, if you have any query towards the end, so we have started now, so we will go up to 4:30. So towards the end, I will take any questions that you might be having. So it is an online session. I hope all of you have joined. Those who have registered yourselves, you have joined and are listening actively. Now, in section 263, if we go to the section as such, the authority to pass the 263 order, the list is a long list. The authorities are Principal Chief Commissioner or Chief Commissioner or Principal Commissioner or Commissioner. That is given in the statute book. What happens in practice is basically Principal Chief Commissioner or Chief Commissioner generally, they do not pass 263 orders. It is generally jurisdictional Principal Commissioner or jurisdictional Commissioner who passes such order, under whom the assessing officers are in the reporting hierarchy. I think it is clear. Let me elaborate this point. Principal Commissioner charges are jurisdictional commissioner charges who have been assigned certain jurisdiction, who have jurisdictional assessing officers, additional commissioners, joint commissioners, assistant and deputy commissioners working under them. So they work on territory basis, assigned area basis, and there are certain functions, certain divisions where the commissionerate is headed not by the principal commissioner, but by commissioner. For example, out of the in the field formation, generally the territorial heads subordinate to respective chief commissioner is a principal commissioner. But in certain divisions like exemptions, like international taxation, the head is not principal commissioner, but somebody a bit junior in rank, or not junior in rank, we can say junior in seniority, they are commissioners. So either principal commissioner or commissioner, generally they pass the orders. And what they have to do, basically, first, in order to pass an order, they have to call for and examine record of any proceeding. And by way of example, in section 263(1), it has been laid down that they will consider whether an assessment order or order of transfer pricing officer is erroneous insofar as it is prejudicial to the interest of revenue. So most of you, or a good number of you, are working as professionals or working for your company to look after tax matters. Generally, 263 proceeding is connected with assessment proceeding. If an assessment order is passed and due to certain reason, it has been discovered later on that some loss to revenue has been has occurred, and the order technically can be termed as prejudicial to the interest of, insofar as it is prejudicial to the interest of revenue, erroneous and prejudicial to the interest of revenue, then the principal commissioner or the commissioner can step in to rectify that mistake by way of 263 order. But I was at the introduction stage, I was speaking about the fine prints. You just have a look in the phrase to call for and examine record of any proceeding. So it is not only assessment proceeding. It is not only 143(3) or 144 or 147 proceeding. It may be a proceeding under section 201. It may be theoretically, it may be a proceeding or even under section 197 or 195 that the commissioner can intervene and try to take remedial measure. I think it is the point is clear. So although in practice, most of the 263 orders are concerned with assessment orders, but the scope and ambit of 263 is wider. It is applicable for any proceeding. For example, penalty proceeding. If the penalty order is not proper, if the penalty order is erroneous insofar as it is prejudicial to the interest of revenue, in that case, it will be the commissioner can intervene through 263 mechanism. Similarly, as I said, already said, 201 or 195, there also the commissioner can step in. I will go to the details of the section. So the authority to pass the 263 order. So who is the authority to pass the order? I mean, as per statute book, it is the principal chief commissioner, principal commissioner or commissioner. But in practice, it is the principal commissioner and commissioner. They are the authorities to pass 263 order. They will pass such order as the circumstances of the case may justify, including they have given certain examples. 1, 2, 3. That is 263(1), clause 1, clause 2, clause 3. What is there in clause 1, clause 2, and clause 3? I will come in the later slide. But the bottom line is, after the authority to pass 263 order will pass such order as the circumstances of the case justify. That means if it is an assessment order, they will pass an order, appropriate order. If it is a penalty order, they will pass an appropriate order. That means order sought to be repeated. What the bottom, the base material is order sought to be repeated. Orders sought to be, revised. Orders sought to be revised. So orders sought to be revised in maximum practical cases. It is the assessment order, and that is the example that has been given. And it may be transfer pricing order also. I will come to that. Similarly, it may be penalty order or 201 order or 195 order. But before passing the order, the commissioner or principal commissioner has to give an opportunity of being heard to the taxpayer, and he will pass the order after making or causing inquiry. So there are two limbs. First limb is to give an opportunity of hearing, and as you know, this opportunity of hearing thing, it is subject to judicial scrutiny. So if the commissioner or the principal commissioner gives opportunity of hearing, but it is not adequate, it is just a sort of an eye wash. Maybe the case is getting time barred. The 263 order is getting time barred in the month of March 25, and he's giving the show cause notice for, say, on 15th of March, gives him 7 days time, and they just for one opportunity, he passes the order. So the courts may not view it as a good opportunity of being heard. Okay, so the department has to be very careful about it. And as practitioners or the opposing parties, sometimes you can look into it whether the opportunity that has been given, whether it is just a technical opportunity or it was a real opportunity. Did the taxpayer get adequate time to explain his case? And commissioner or the principal commissioner, before making the order, can make or cause inquiry as deemed necessary. So make or cause inquiry, that can be done from a study of the file, from a study of the case record, from study of the submissions before the commissioner that the taxpayer may give. In appropriate cases, the commissioner may call for certain reports from the assessing officer also. And another thing is giving opportunity of being heard. So one question may be whether a show cause notice, generally before passing order, at the initiation of 263 proceeding, a show cause notice is given to the taxpayer. Why? The order will not be regarded as erroneous and prejudicial to the interest of revenue. But sometimes the court view is this giving opportunity of being heard, there may not be a formal show cause notice. Okay. There is a celebrated case. I'm not giving the ITR. It may not be a citation. It may not be that much significant, but just you hear about it. There is a case you will in Google search. If you Google search, you will get the citation also. It is in the case of Amitabh Bachchan. So there was certain 263 proceeding and some requisition, which I think may have been made in the order sheet, and the taxpayer, that means Amitabh Bachchan or his counsel, took this position that no formal 263 notice was given. So the court observed, it went up to Supreme Court. The Supreme Court observed, the Supreme Court fortified this view of the lower authority that giving show cause notice is not fundamental or a primary requirement. The matter is to give an opportunity. If the opportunity is given by way of signing in the order sheet or by way of sending a letter also, that will suffice. So that was that issue came up because that time everything was manual. Nowadays also, so far as 263, 264 is manual, but generally, at least in practice, what happens is the commissioners or the principal commissioners gives a show cause notice or give opportunity of hearing through a letter. So as practitioner, what you will see, since the Supreme Court Supreme Court order is there, so you may not be so much technical about the whether it was a proper show cause notice, but you may agitate whether the opportunity was sufficient opportunity. That is it. So I'm moving to the next slide. So the keyword in section 263 is the commissioner or the principal commissioner can intervene as a remedial measure, can take recourse to section 263 if the order to be revised is erroneous insofar it is prejudicial to the interest of revenue. So I'm using a short name for it. It is EIPIR. I'm writing in short. It is not a technical word. It is not to be found in statute books. And what is the meaning of erroneous insofar as prejudicial to the interest of revenue? That is given in explanation 2 below 263. Section 263 incidentally have 3 explanations. All of them are very important. So erroneous insofar as prejudicial to the interest of revenue, which is the touchstone of, so we can say, to section 263. It is given in explanation 2 below 263. It was inserted, it is very important. It was inserted by the Finance Act 2015 with effect from 1/6/2015. So it is almost 10 years, because what constitutes erroneous insofar as prejudicial to the interest of revenue was subject to litigation. There was various interpretations of various courts. Even today, the controversy is there, but the situation is much better after insertion of the explanation. So we are going to the explanation now in the next slide. So I have used the word 263 passing authorities. For a recap, who are the 263 passing authorities? 263 passing authorities are the, for all practical purposes, principal commissioner or the commissioner. In the opinion of the 263 passing authorities, the order passed by the subordinate officer, being assessing officer, has been made without making inquiries or verification. Without making inquiries or verification. In fact, the phrase is not complete here. I can write it. The order is passed without making inquiries or verification, which should have been made. Order passed without making inquiries or verification, which should have been made. So if we stop at order passed without making inquiries or verification, it will make it will indicate that if an order is passed without inquiry, lack of inquiry, then 263 can step in. But the explanation 2, because many times courts used to tell that if lack of inquiry is there, 263 can be done. But if there is inadequate inquiry, 263 will not be proper. That controversy is still there, but still the government position or the revenue position is now much better with the introduction of this phrase, order passed without making inquiries or verification, which in the opinion of the commissioner should have been made. So there is an element of subjectivity there. There is an element of subjectivity. What is the degree to which inquiries or verification should have been completed? Second is order is passed allowing relief without inquiry. Particularly in large corporate cases, there are a lot of claims for exemptions and deductions, maybe a TIC deduction, or previously a TIB, or even before that in the earlier era, a THSC deduction, all these 10A, 10B, 10C, all these deductions, 10E deductions, all these deductions. So these reliefs, if they're or even for that matter 89(1) relief, applicable for a salaried person if they are allowed without proper inquiry by the assessing officer. Then to make a prima facie a case for 263. Okay. So one thing I must interject here, that sometimes, not always, but in very rare cases, it may be 263 order proceeding has been initiated, but it is found the assessee or the taxpayer could establish that he had they can satisfy the commissioner that what they had done, they had represented well, and what the assessing officer conclusion was taken by the assessing officer was correct, given the circumstances, given the facts of the case. In some of the cases, the commissioner can drop the 263 proceeding also. So far as explanation 2 is concerned, explanation 2 is concerned with the definition what constitutes order erroneous insofar it is prejudicial to the interest of revenue. So mind the wording. Wording is very important. It is not erroneous and prejudicial to the interest of revenue. The wording is erroneous. The order has to be erroneous insofar it is prejudicial to the interest of revenue. That means if an order is just an erroneous order, it may not constitute prejudice to the revenue. But if erroneous insofar it is prejudicial to the interest of revenue, then 263, there is a case for 263 stepping in. So the first limb is order passed without making inquiries or verification. Second limb is order passed allowing relief without inquiry. Third limb, order is not passed in accordance with order. Order means the orders ought to be revised. Is not passed in accordance with order, direction, or instruction of CBDT. I give a small example about penny stock cases. About penny stock cases, there has been elaborate instructions or directions from the CBDT, Central Board of Direct Taxes. And you all are senior professionals, you must be knowing that circulars are open to both the taxpayers and the departmental officers. But instructions are meant only for the departmental officers and instructions are binding on them. So if there is an assessment order in penny stock cases, which is contrary to the SOP or the direction or the instruction of the CBDT, then the commissioner or the principal commissioner can take a position that the assessing officer has passed the order which is not in accordance with the direction of the CBDT, and therefore it comprises a case for 263. Sometimes the order is in violation or in opposition to some pro-revenue order of Judicial High Court or Supreme Court. It may happen. Sometimes due to ignorance or for whatever reason, time pressure or whatever, oversight, the assessing officer may take a position which is just contrary to the sayings of the Judicial High Court or even the Supreme Court. In that event, as long as it comes to the notice of the commissioner, he can intervene and make case for 263. I give one example. For example, employer's contribution to PF. There has been a Supreme Court order. So in many cases, previously, the assessing officer had passed orders which are in favor of the assessee. So the two, they have taken into consideration the submission of the officer, submission of the assessee or the taxpayer, and passed order in favor of the assessee. But after the Supreme Court case, it was the law of the land was declared, and simultaneously there was a prospective amendment of the law also, but that was that amendment basically was a declaratory amendment. So that is the position of the law. That is the position of the statute. So therefore, in many cases, the commissioners did step in and initiated 263 proceedings for orders wherein the relief has been given to the taxpayers in respect of employers' provident fund and like. Okay, employers' contribution to provident fund. Now, if the assessment order is erroneous, insofar it is prejudicial to the interest of revenue, as I said, 263 can be initiated for any proceeding, but for all practical purposes, it is the assessment order which is mostly subject to 263 proceeding. So 263 passing authorities will pass an order. How they will pass an order? They will pass an order after giving an adequate opportunity of being heard to the taxpayer or the assessee, and after making such inquiry as may be necessary in the facts of the case. So they will pass the order. The commissioner, the principal commissioner will, so far as an assessment order is subject to 263, they will, under section 263(1) small 1, 263(1) clause 1, there are three alternatives: enhancing the assessment, modifying the assessment, cancelling the assessment, and directing a fresh assessment. Enhancing the assessment, it is very much understandable, self-explanatory. If the assessing officer had given relief into 80 IC, and the officer has, the commissioner finds that the deduction or the relief has not been given correctly, it is causing prejudice to the revenue, and then he can enhance the assessment by disallowing that relief. He can modify the assessment. Maybe the assessing officer has made addition under section 68, but he did not apply the appropriate tax rate 60%, that is under 115 BBE. In that event, the commissioner can step in and modify the assessment to that extent. Or the assessing officer had given certain relief or did not make certain additions. So prima facie, the commissioner finds that the order is erroneous insofar as it is prejudicial to the interest of revenue. He gives a notice to the taxpayer on, say, 4 points. So after getting the show cause notice, the assessee gives an elaborate reply. There may be 1 round of hearing, there may be 2 rounds of hearing, whatever. So after going through the reply, the commissioner may find that out of the 4 points that he has flagged in the show cause notice, at least in 1 point, the assessee has correctly explained his position. So from that angle, the assessing officer's action on that point cannot be said to be erroneous insofar as prejudicial to the interest of revenue, although prima facie it appeared so. So therefore, out of 4 points, while passing the order 263, the commission may modify the assessment by making addition or making disallowance on the 3 points and leaving the other point as such. So while in the first option, the assessment as such was enhanced, here the assessment is modified to that extent. How? It may be in some point the 263 has not been proceeded with, or it is modified as I gave change in tax rate, something like that. But what happens in practice is mostly because many a time the assessment requires some more inquiry, gathering some more details, causing some more inquiries. So in that event, the principal commissioner or the commissioner, they do not have time to go through all those nitty-gritties. So what they do, after considering the submissions of the taxpayer or the assessee, if they find that the reply is not to his satisfaction and the action of the assessing officer was also not correct, in that event he can cancel the assessment and direct a fresh assessment to be made, de novo assessment. Okay, so it may be fresh assessment on maybe fully, or it may be limited to 1 or 2 points. So nowadays, after what is the, I mean, what is the what do you call business process in the department? The assessments are done on faceless manner. Okay, so you will find a case where the principal commissioner and the assessing officer is sitting in Calcutta or Odisha, for example. That case goes to some officer in Kerala. He has completed the assessment, and after in faceless manner, and after that the demand notice and the assessment order comes back to the jurisdictional officer for recovery purposes. And if there is any mistake committed by the faceless officer, now it is a jurisdictional commissioner. Jurisdictional commissioner, he will take the 263 proceeding. So generally, they also want, after the 263 order is passed, if he makes a cancellation of the assessment and direct a fresh assessment, or as a whole or on certain points, sometimes it is seen these days that they are making the assessment is partly set aside. So partly set aside means it goes to the assessing officer in the jurisdiction, so that it is again a for the benefit of the taxpayer also, because it is easier for them to comply to the short point. So if it goes to the faceless regime, faceless jurisdiction, then it will again go to somewhere else. And I mean, it may be may not be very, I mean, this is just as a business process. So what the principal commissioner or commissioners are doing in 263, sometimes they are making it partly set aside on certain points, so that the jurisdictional officer can take care of that issue and appropriate remedial measure taken. So I hope I'm going in correct speed. I'm not getting any feedback. If any feedback is possible from any participants, I'd be happy. Am I going too fast or too slow? Any feedback? Now, if we go to 263, I said 263.1.1, there are two clauses. One, order enhancing or modifying assessment and directing a fresh assessment. Number two and three are regarding transfer pricing order, TPO's order. You know, if in a case there is transfer price, I mean, there is international transaction and the case is flagged by the CBDT for reference to the TPO, then the assessing officer on the points of international transaction goes to the transfer pricing officer. In which cases this can happen? This can happen when it may be a domestic company, but it may have international transactions, maybe with its domestic company, maybe a subsidiary company with its principal, with its it may have international transactions. It may be a foreign company having branch in India. It may have international transactions with its head office, or there may be domestic TP also. In either case, during the pendency of the assessment, for valuation of the international transaction or to find the arm's length price of the international transaction, the assessing officer refers the case to the TPO. TPO, after hearing the SSC, after giving it an opportunity of being heard, passes an order, transfer pricing order, which becomes binding on the assessing officer. The assessing officer accordingly passes the assessment order. After taking, for example, there may be in an assessment, there are, let us say, two issues. One issue is, say, some expenditure, some foreign travel expenditure incurred by the company, and second is a, say, purchase transaction from sister organizations, or it is called related party transaction. So there is one foreign travel expenses, which has nothing to do with international transaction. It is foreign travel, but it is just a question of allowing it under section 37(1) or not, whether it is incurred for the purpose of the business. But the second point in the assessment is about purchase transaction from the related party. It may be its head office or any sister concern. So for the 37(1), the assessing officer himself is competent to do that, the exercise. For the arm's length thing, he has referred it to the TPO. Now, TPO has passed an order suggesting some adjustment in the transaction. So while passing the order, the assessing officer will make the, say, disallowance either full or partial in respect of foreign travel. And for the TPO, he will just, for the transfer pricing part, he will just reproduce the TPO's opinion, and then he passes the order, draft or whatever. Now, question is, if there is some mistake committed not by the assessing officer, but in the TPO order, who will rectify that order? If the because transfer pricing, definitely it is a valuation. It is determination of arm's length price. So while determining arm's length price, there may be mistake committed by the error committed by the TPO. Erroneous insofar it is prejudicial to the interest of revenue. Then who is the authority who can correct that TPO's order? So there was a lot of controversy. In all practical cases, generally the jurisdictional commissioner, that jurisdictional commissioner means jurisdictional commissioner to whom the assessing officer reports, used to take 263. But generally the court's view was the jurisdictional commissioner does not have any competence or jurisdiction to interfere with the order of the TPO, because he doesn't report to him also. He is not an authority subordinate to TPO, subordinate to the commissioner. So who is to pass the order? The 263 order in case of transfer pricing or transfer pricing transactions will be completed by the CIT transfer pricing. I hope this point is clear to all of you, because in international in income tax hierarchy, there are jurisdictions, as I said, and there are certain other verticals like exemptions, like international taxation, and like transfer pricing. So when there is a case flagged for transfer pricing, for valuation purpose, it goes to the TPO, and TPO, to whom the TPO reports? TPO reports to his commissioner, who is Commissioner TP. So if any error is committed by him, by the TPO, that 263 remedial measure will not be taken by the jurisdictional commissioner, but it will be taken by the CIT TP. Actually, for this, there has been an amendment in the Finance Act 2022 with effect from 1/4/22, and this has been laid down in detail in clause 72 of Finance Act 2022. If somebody is interested, they can see the relevant circular. Now, as I said, Section 263 has three limbs, three explanations. It has three explanations: explanation 1, explanation 2, and explanation 3. Explanation 2 is concerned with erroneous insofar as it is prejudicial to the interest of revenue. Explanation 1 has three limbs: 1A, 1B, and 1C. I'm coming to that. So explanation 1, the first limb is what are the orders which may be subject to 263. So basically, it has started with the saying of section 263 that order of any proceeding. But in explanation 1A, what they have clarified is sometimes what happens is the assessing officer is passing some order. Now, his immediate superior, being joint commissioner or additional commissioner, may give him certain specific direction in that case. That specific direction is given under section 144A of the Income Tax Act. Second, sometimes the assessee may raise certain, the assessee may have certain issue with the assessing officer. The assessee may not be in agreement with the view taken by the assessing officer. So he may want, the assessee or the taxpayer may want some sort of umpiring to be done by the range, that means the joint commissioner or the additional commissioner who is the superior of the assessing officer, ITO or ECDC. So in that case, the assessee may apply to the joint commissioner or the additional commissioner for issuing certain direction under section 144A. So, and that direction under section 144A becomes binding on the assessing officer. So I understand, or I presume, there may be in certain cases, there may be order passed by the assessing officer in accordance with direction issued by the range head under section 144A. So this point might have been litigated in the court. Point might have been raised that this order is not subject to 263. Why? Because the assessing officer has not passed it on his, on his own, but it has been guided by another authority, being joint commissioner or additional commissioner. All said and done, joint commissioner or the additional commissioner is an authority subordinate to the commissioner or the principal commissioner. So even if the assessment order is done as per direction of the joint commissioner or the additional commissioner, the PCIT or the commissioner has full jurisdiction to correct or take any remedial measure, initiate any 263 proceeding for those kind of order also. This has been clarified by explanation 1. Basically, it is 1A. Explanation 1A. It is clarification. It has been clarified and it has been made clear. Second, what is record? Because 263, what is the starting point for 263? A proceeding has to be there. Second, in any proceeding, the commissioner or the principal commissioner can call for and examine the record. Can call for and examine the record. So what is very vital is the record. That means in case of assessment, it is assessment record. In case of penalty proceeding, it is the corresponding penalty record. If it is 201 proceeding, it is a 201 file or 201 record. So what the record includes? Record includes, I'm reading it verbatim, explanation 1B. Record shall include and shall deemed always to have included all records relating to any proceeding under this Act available at the time of examination by the Principal Chief Commissioner or Chief Commissioner or Principal Commissioner or the Commissioner. So what is important is record. What will constitute record? Record will constitute record as it appears or the record as it is there at the time of examination by the Commissioner or the Principal Commissioner. So if it so happens that an assessment has been completed, so some audit has been audit has raised certain query or objection. So when the Commissioner is consulting the record, he is examining the record, the audit objection is already on the record. So he can initiate 263 proceeding because on the basis of the audit objection, I mean, taking the spirit of the audit objection, because now it is a part of the record. True, it was not a part of the record when the assessing officer has carried out the assessment. But what is important and material for 263 proceeding is what is the status of the record when the assessing officer, when the Commissioner is conducting the examination. And there are certain orders which are outside the purview of 263. So here also verbatim, the order referred to in this subsection and passed by the assessing officer or the transfer pricing officer as the case may had been subject matter of any appeal, the powers of the Principal Commissioner or Commissioner shall extend and shall deem to have extended to such matters as had not been considered and decided in such appeal. So generally speaking, the accepted view is if there is an appeal against the assessment order. So points that are covered in the appeal order, in the appeal memorandum, are not to be revised. Although there is certain exceptions to these, which I will discuss when I will discuss the case laws. So basically, when an appeal is filed, it may be taken that the appeal has been admitted. So whatever the points of appeal or grounds of appeal are there, that becomes outside the purview of the Commissioner. Although there are certain exceptions that I will do while I do the case laws, discuss the case laws. Time limit is very simple. 2 years from the end of the financial year in which orders are to be revised was passed. So this is true for assessment. This is also true for transfer pricing also. So this time limit is given in section 263 subsection 2, and there are certain exception, section 263, because sometimes what may happen that there are certain directions of the court, directions of court in certain matter, in certain case. So there, if 263 can be taken recourse to, even if 2 years have already passed. Okay. Now, the assessment order has been passed. The assessee is happy because the assessing officer has accepted his submissions, or he may be partially happy. The assessing officer has not listened to him in full, but made certain additions against which he has gone on appeal. Now, the second jeopardy comes in the form of 263 notice. So 263 notice have been 263 order has been passed, and now what is the option open to the assessee? Assessee goes to the tribunal. Assessee goes to the tribunal to challenge the 263 order. Okay, they can challenge the 263 order. Now, if the tribunal passes the order in favor of the assessee, Then what is the remedy to the department? Department can go to the High Court if there is any substantial question of law, SQL involved in it. Okay. So if the tribunal orders and if the tribunal okays the 263 proceeding, 263 has been passed against the SSC. SSC moves the tribunal. Tribunal said no, the commissioner was exercised his jurisdiction correctly. Then the remedy available to the SSC is he can go to the High Court. Similarly, if the tribunal quashes the 263 proceeding, the department can go to High Court under section 260A of the Income Tax Act. Now, let us assume one case. In one case, the SSC, as I said, the assessing officer had passed an order giving relief under section 80 IC. The SSC claimed deduction under section 80 IC and the assessing officer allowed it. Now, there was certain audit objection or whatever. The commissioner has passed a 263 order asking the assessing officer to re-examine the issue and compute deduction accordingly. It may be either full disallowance or partial disallowance, whatever. The details are to be worked out by the assessing officer. And that order has to be passed within that time frame, within certain time frame as given in section 153 of the Income Tax Act. Now the SSC may go to the tribunal directly against the 263 order. So before even the assessing officer could complete his fresh assessment, the tribunal says this order is without jurisdiction. The PCIT has not taken his power, has assumed his power without jurisdiction, and the order is to be quashed. So then what will happen to that assessment? The assessment was by virtue or it was triggered by the 263 order. Now, if the 263 order is quashed, irrespective of the fact whether the department goes to the tribunal, against the tribunal's order, goes to the High Court or not, the assessment order does not have any leg to stand on. Therefore, even if the assessment is completed, and the SSC files an appeal before the Commissioner Appeal, the Commissioner Appeal will observe that this assessment is in consequence to 263 order, and the 263 order has been quashed. So this the assessment becomes infructuous. Okay. So as I said, 263 law is there, although in the law, even the principal chief commissioner or chief commissioner can pass 263 order. In practice, it is the principal commissioner or commissioner. So far as assessment is considered, it is principal commissioner assessment, of that territory, or if it is exemption charge or international taxation charge, it is the corresponding commissioner. If it is TDS charge, the corresponding commissioner in case of 201 order and like. When is record called for an examine? Thousands of orders are passed by the assessing officers. In what circumstances the commissioner can call for the record and examine? So there is something departmental procedure called review and inspection. The commissioner can review the performance of the assessing officer or carry out certain inspection. There's some irregularity or loss of revenue can come to his notice. Accordingly, he can initiate 263 proceeding. In all practical purposes, many times what happens is audit, either internal audit or external revenue audit, may raise certain objections. In that event also, record is called for and 263 is initiated. Now there are certain issues return is processed under section 143(1) and there is no assessment. So whether there is scope for 263 on that. Okay. So generally the view particularly is 143(1) is not an order. Particularly this issue has been dealt with at length by the Honorable Supreme Court in the Rajesh Javeri stockbrokers case, where it has been laid down, although it was in the context of 147, till there it was told that 143(1) is not an order. It is an intimation, it is not an order. So generally 143(1) will not be even if some allowance is given, it is a conscious decision. It is system generated intimation and 263 jurisdiction will not apply. Now, in the assessment, what happened is some query was raised and the issue was discussed in the assessment order, which may not be to the liking of the commissioner. In his opinion, the order is erroneous as well as to the extent it is prejudicial to the interest of revenue. Whether 263 will apply. So third possibility is query raised and replied. There is no discussion in the assessment order. So in this point, first point, there is one ruling of the Supreme Court in the Usha International. Usha, not Supreme Court, it is basically Usha International full bench Delhi High Court case. There, the Honorable full bench of the Delhi High Court, they said that if query raised and issue is discussed in the assessment order, 147 cannot be initiated. 147 means 147 pre-amendment 147. It cannot be initiated. If query raised and replied, even though there is no discussion in the assessment order, it may be taken that the assessing officer has accepted the views of the assessing. So 147 cannot lie in those cases. But in the Usha International case, it was commented by the honorable judges that the department is not without remedy. The department can take recourse to 263 in such cases. But we have to keep in mind that was basically that judgment was regarding 147. So what the judges have said about 263 is basically not an issue decidendum of the court of that case, but a sort of obited dicta, side view. So query raised and issue discussed in assessment order, sometimes it is becomes very difficult in the court for the department to sustain it. And the courts generally view if the query is raised and the issue is discussed in the assessment order, so CIT taking 263, it amounts to change of opinion. Sometimes the courts take that view, tribunals and courts. Even when query raised and replied, although no discussion in assessment order, sometimes the courts are not very kind to the department. They say that no, it has been already looked by the assessing officer. There are two possible views. He has taken one possible view. So there is no error. It cannot be said to be an order erroneous insofar as it is prejudicial to the interest of revenue. Certain landmark case laws, you can take law. I understand this presentation will be there with the CMA and they will give you copies. So these are certain landmark case laws. Malabar Industrial Company Limited. Interestingly, the Malabar Industrial Company Limited case is a revenue favorable judgment. But the observations made by the honorable judges there, many a time it is used by the practitioners, and you can also take help of this ruling to argue the case in their favor. And many a time the tribunals and the high courts are very much amenable to this Malabar case. Second case is Pavile Projects Private Limited versus CIT. It is Supreme Court. It is very revenue favorable case. I'm going further. These are very landmark cases. Now I go to revision of other orders 264. So 264 who to pass? Similarly, Chief Commissioner, Principal Chief Commissioner, Principal Commissioner, Commissioner. In all possibility, it is in all practical purposes, it is the Commissioner or the Principal Commissioner who passes this order. Here also, the vital thing is calling for record. Generally, 264 is taken recourse to when the SSC applies for, files and request before the Commissioner for 264. 264 proceeding is basically a mercy petition in view of, mercy petition by the taxpayer. By 264, he is withdrawing his right of appeal and making plea before the Commissioner to view his case sympathetically. And exclusions, what are the exclusions? 264.1 orders that are subject to 263 cannot be made this thing 264. Orders that are pending in appeal before the appellate authorities, whether it is Commissioner appeal, it cannot be done under section 264. In cases where appeal has not been filed, but the period of appeal has not expired, that SSC also cannot move it to 264 petition. If he at all moves to 264 petition, he has to express in writing that he is waiving his right for appeal. And 264.4, there is one that is 264.4 is basically these exclusions are laid down in section 264.4. So if you consider 263 and 264 by way of weight, 263 is much more of concern for the practitioners. 264 we don't get much cases. In appropriate cases only the taxpayers are advised to go to 264 because many a time the taxpayers or the council may find that filing appeal is a better course. Now in 264, in 263, the purpose is to correct the error caused by the assessing officer. And here the 264 order will be passed by the Commissioner. The order has to be not prejudicial to the interest of assessing. And what it means, it is explanation 1 below 264. So because what happens is in 264, it is a mercy petition. The SSC asks certain additions to be deleted or some disallowance to be some additions to be deleted or some deductions to be allowed like that. So the Commissioner has two options. One, he can allow that. Sometimes he may refuse to interfere with the order. If he refuses to interfere with the order of the assessing officer, that will not be an order prejudicial to the interest of assessing. Because he is not enhancing the assessment. He doesn't have any power to enhance it. What he's doing, he is withdrawing. He's refusing to entertain the 264 petition, either on technical ground or whatever. So 264, the SSC has to be very sure because while doing 264, he is basically giving up his right of appeal. So I give you one case of Calcutta High Court, Uttanka Rai versus Director of Income Tax, where it was a case of a non-resident, marine engineer. It was surprising, it was not even 143.3 order, it was in 143.1 proceeding, where his claim for exemption for his salary received in India for serving abroad was denied in processing under section 143.1. He submitted a petition, he filed a petition under section 264. The commissioner order was in two parts. In one part, the commissioner even mentioned that the assessee is a non-resident and he served in foreign in ship outside the territory of India. All these things have been facts have been mentioned. Yet he remitted the matter back to the file of the assessing officer. So if the 264 the order is adverse to the assessee, the only remedy, because he has withdrawn his right of appeal, the only remedy available for him is to file a writ petition. Fortunately, in his case, Uttam Ray's case, the order of the Calcutta High Court was favorable to him, and the Calcutta High Court made a very categorical observation that the power of the commissioner under section 264 is very wide. He could, having noted that this person is a non-resident, he could have given the relief himself. It was not proper for him to again refer back to the matter to the assessing officer. So that is what 264. 264 is a very sharp knife to be used very carefully by the taxpayers because of only one reason, because he is giving up his right of appeal, and the only remedy in case of an adverse order or not interference order is to file a writ petition. Here also, like 263, the order passing authority, commissioner, principal commissioner, he may inquiry or cause such inquiry to be made. And difference between language, for example, in 263, what are the, by way of example, certain orders were mentioned, assessment order, what the PCIT can do in the assessment order, what the CIT can do in respect of CITTP can do in respect to P order. Those details are not there in 264. The only thing is the order has to be passed within a definite time frame, and it will not be prejudicial to the interest of revenue. Another difference is also coming. I'm coming to this. Time limit 264.2, time limit for application 264.4, 264.3. I'm not going details into these sections. You can just giving you the section heads, and that is a fee, prescribed fee of 500 rupees from time immemorial for this 264 petition. There is time limit for passing order also, 1 year from the end of this thing, and exclusion is 264.6. 264.6 that the order has to be passed 1 year from the end of the financial year in which the application was made. Now, exclusion is of course like 263. 263 orders can be made at any time in the event in order to follow some direction of some courts. Similarly, in 264 also, even if the time of 1 year is gone, in order to give effect to direction of any court, this time limit will be relaxed. And 264, these exclusions, I mean, what are they? I have already discussed them. If time for appeal has not expired, right of appeal is not withdrawn, the assessee cannot file 264 petition. So if they can file 264 petition after withdrawing his right of, after expressing in writing that he is withdrawing the appeal. And if appeal is pending before the appellate authorities, he cannot file 264. He can withdraw the appeal. And there are judicial pronouncements that appeal one file cannot be withdrawn. Sometimes what happens that the appellate authorities declare the appeal to be infructuous. They don't give relief, or they do not give credence to the withdrawal application. They say that now it is infructuous. So these are the other points about 264. As I said, that remedy for the adverse order by the commissioner or the principal commissioner against a 264 petition made by the SSC is to file a writ petition before the jurisdictional high court. Of course, to the department, there is nothing, there is no remedy. The principal commissioner or the commissioner, the designated officer of the department is empowered to give relief to the SSC, or is also empowered not to interfere in the petition, not to entertain the petition. A record here in 263 record for all practical purposes, record is called for when, first of all, when there is an audit objection. So records are called for. Second, there are review and inspection exercises carried out by the commissioner or the principal commissioner regarding the working of the subordinates. Then if they find that there is something erroneous order, they can step in. 264, generally, suo motu is not done by the commissioner, although in statute it is given that they can do suo motu 264. Nobody does that. Only when the SSC moves the petition, records are called for. And generally, when the record is called for, the commissioner or the principal commissioner calls for certain report from the assessing officer. Now, processing under section 143(1). In processing under section 143(1), as I said, that 263 will not be applicable. So also 264. 264, at one time it was written that for the purpose of 153(1), it will be deemed as an order under section 264. But that has been removed. But yet in practice against 143(1), 264 petition has been filed. As I have already cited one case of Uttanko Rai that was filed. But generally opinions are divided. Mostly the majority view is that there should not, these 143(1) being not an order. So neither 263 nor 264 is possible. In 263 against the TPO order, vis-a-vis the TPO order, TPO passes the order, the CIT TP as per the amendment section, amended section 263 can pass a 263 order. But against the TPO order, there may not be any 264 petition. If 264 petition is there, it may not be entertained even, because 264 TPO's order is just a valuation order and it is not a standalone order. There is no demand notice on that. On the basis of the TPO's order, the assessing officer will pass an order. So there cannot be a mercy petition against the TPO's order. Now, you know that in case of foreign companies or in cases where reference has been made, either in case of foreign companies or domestic companies, for transfer pricing, either or on international transactions or on domestic transactions, the assessing officer, if there is an adjustment mentioned by the TPO, or if there is an adjustment made by the assessing officer himself in case of international taxation, in that event, first of all, the assessing officer will have to pass a draft assessment order. Against the draft assessment order, the SSC can file submissions before the dispute resolution panel. The SSC can file objection before the dispute resolution panel. And the DRP will issue, after hearing the SSC, will issue directions to the assessing officer, and accordingly assessing officer will pass an order pursuant to the direction of DRP, which is binding only. Now question is whether these orders, which are passed in accordance with the collegium comprising 3 commissioners, whether they may be subject to 263 and 264? Answer is yes, because ultimately the order is passed by assessing officer. This becomes order under section 143 or 144 or 147. That it has been passed as per direction of DRP is second term, but it is not an order of the DRP. DRP only issues direction which is complied by the assessing officer. So if in the opinion of the commission, jurisdictional commissioner or the principal commissioner, there is some error committed in so far as it is prejudicial to the interest of revenue, 263 can happen, and also 264 theoretically it can happen, although there are certain practical difficulties because the commissioner may say that no, you had gone to DRP and DRP, whatever DRP has sent after giving you opportunity, the assessing officer has passed an order, and I mean, I refuse to interfere in this order. Now, I made the mention of this Malabar Industrial Company as a landmark case. They made that the phrase prejudicial to the interest of revenue has to be read in conjunction with erroneous order if AO has taken one possible view out of two views possible, then it cannot be treated as erroneous order prejudicial to the interest of revenue unless the view taken by the AO is unsustainable in law. So many times the tribunals and the High Court give relief to the assessee, citing this paragraph of the Malabar, although Malabar itself is a revenue favorable order. I give one example how it can be give example. There is a case in CIT versus Usha International also similar provision was taken. If there is error, section 263 is available. If incorrectly or erroneous applies law or comes to a wrong conclusion, application of law in a wrongful manner or on factual wrong conclusion drawn, then 263 is remedy. But 263 will be invalid on the ground of change of opinion. Here is an example. In one case of milk cooperative in Gujarat High Court, there was 80p deduction. And 80p deduction is a controversial area. So there are various conflicting judgments of various courts. The assessing officer had taken a view which was a legally possible view. So which was not to the liking of the principal commissioner. He initiated 263 proceeding, but the Honorable Gujarat High Court said that no. This issue is a debatable issue. There are two possible views. He has taken one view. So you cannot say that order is not sustainable in law. Commissioner cannot supplant his own view with the views taken by the assessee. Now, audit objection. If there is an audit objection, there is revenue favorable judgment. In the case of Punjab High Court, there is some ruling. And for you practitioners, you can look into this B&A Plantation Industries, Guwahati High Court. The second bullet is Guwahati High Court. This is favorable to assessee. Here the Guwahati High Court said no. The conclusion has to be done by the commissioner's own conclusion. If it is done at the best of audit objection only, he is not applying his mind. So on that count, you can fight. But after introduction of explanation to section 263, where explanation 1, where record has been defined, that it means record as available to the commissioner containing even the audit objection. The point of the assessee to take this stand is a bit weak, but still Guwahati High Court, you can take a view that it was only at the instance of the audit. I mean, it is how you play. Only at the instance of the audit objection, the commissioner had taken this stand, and it was not his original. I mean, it was not his own application of mind. You can try. It is said that if appeal is made, then on that point 263 cannot lie. So I said that there are certain exceptions. There is even one Supreme Court said Enco Limited versus CIT. What happens is there was some share allotment done by the domestic company to its foreign collaborator in lieu of technical advices and consultancy. They passed some entry and claimed certain expenses on the share allotment. The assessing officer told that no, it is not a revenue expenses, it is an capital expenses, and he allowed either 1/4 or 1/14 he allowed. But PCIT's point was this allotment of shares, it is not an expenditure. So he initiated proceeding under section 263. The SEC challenged that the assessing officer had made certain addition, 1/4 or 1/14, whatever, and I'm in appeal. How can the CIT or PCIT can initiate 263 proceeding against a point which is a subject matter of appeal? Here the court, it has gone to Supreme Court. Supreme Court have taken a stand. I mean, they have endorsed the view of the Judicial High Court that this share allotment, it is not an expenditure basically. Basically that is transaction in the capital account, but it is not an expenditure to be debited in the PL account. So the order of the assessing officer can be said to be erroneous and prejudicial to the interest of revenue, and the point of appeal is here, it is not the point of appeal. So the order was sustained. Similarly, this is a tribunal, Rajkot tribunal, but it is interesting. Here, the addition was made under section 268, but it was taxed at ordinary rate. The CIT initiated 260 proceeding said that no, the tax has to be calculated under section 115 BBA. This portion of the judgment was, this portion of the 263 was sustained by the tribunal. But on the second count, there was some 69C addition on bogus expenses. The tribunal said this bogus expenses, excess salary or whatever, is to be disallowed under section 37(1), and there is no question of 69C or 115 BBE. So as of now, I don't know what will happen at High Court, but as of now, in this case, the 263 was dismissed. So in similar cases, if you practitioners, you get certain issue like this, you can always refer to this case law, this 154 taxman.615 on the second point. In such assessment, it is passed with application approval by the Joint Commissioner or the Additional Commissioner. So there is some Delhi tribunal and other tribunals. They say that the assessment order is passed by 153. So CIT passed 263. They say that no, you cannot say the order passed by the assessing officer by looking into the records of only the assessment order. It has been passed with approval by the range head. You did not look into the record of the additional commissioner. So this 263 is invalid. So this is some technical relief given by the tribunal, but it can be of help to you if there are certain 153D cases. You can take this help of this judgment also. Penalty initiated on wrong section. In place of 271(1)(c), the assessing officer initiated penalty under 271(a)(b). So here, the ITIT Jodhpur has ruled that it is not a question of wrong mentioning of section, because in the assessment order, the assessing officer had mentioned both 271(1)(c) and 271(a)(b), but he expressed satisfaction only for 271(a)(b). So revisional order directing AO to initiate penalty under section 271 by recording independent satisfaction is not justified. And here the tribunal noted another thing. What is the order to be revised? There is no penalty order here. It is just an assessment order. And that time for initiation of penalty is already over. So you cannot just take another innings in reviving the penalty, which has already been barred. There are certain Delhi High Court decision also. In one case, the assessing officer, in fact, this ruling is here also. In one case, the assessing officer forgot to make 271 penalty, initiated penalty. The assessing of the CIT initiated 263 and said that you did not, in this case, there has been concealment, but you did not initiate penalty under section 271(1)(c). So it is erroneous as well as prejudicial to the interest of revenue. Here the Delhi High Court had taken the similar stand. They said that there is no penalty order here. You cannot just revive the assessing officer for non-mentioning of penalty. Similarly, there is CIT versus CRK Swami, Madras High Court. There is some ruling that is also favorable to the SSC. PCIT versus Chennai Metro. It is also favorable to the SSC, but with a slight change here. The Madras High Court said that no. CIT can initiate if penalty is not correctly initiated. CIT can take remedial measure. But here the PCIT had taken certain observation which is not correct. That is why the PCIT's order was perverse. So here the favorable ruling came to the SSC on point of perversity, not on point of like Sudarshan Talkies or CRK Swami, where the courts have said that for non-initiation of penalty, there cannot be a 263 order. This is very important. Sometimes department wants to take time. So there is one assessment. After, say, in one assessment, there was certain issues, 3-4 issues. Then there was 147 after 4 years. And in the original assessment, there was certain issue which was not touched by the assessing officer. The PCIT, he issues 263 notice covering a point of which was not originally looked into by the original assessment. Here, it is a Supreme Court observation. It should be very useful to you practitioners, those who are practicing, for exercising powers under 263. The period of limitation has to be reckoned from the date of original assessment and not from the reassessment, because otherwise it will be a draconian situation. Year after year, the department will revise its assessment, and then it will try to rectify itself some point which was not looked after by the original assessing officer. So this is not to be taken. This has to be, you can cite the Supreme Court said to if you face any such situation. Now, mode of conduct of proceeding. Mode of conduct of proceeding 263 and 264. Till now, it is interfacial with the jurisdictional principal commissioner. It will be either a face-to-face proceeding or through email. Although section 263A and 264A provisions are there, faceless provisions, but they has not been notified as yet. And I think it is okay if the senior officers, principal commissioner or commissioner, if he takes the interfacial or jurisdiction, then it is, I think, okay. So that is how the process is going on. So we have looked into basics of section 263 and 264 today, and I think my time is already over. I've tried to cover the whole gamut of the section, and it is time to say thank you. And if you have, I think I've already passed any time, but still, if you have some short question, you can ask me.
Sir, this is Priyanka. Yes. There are no such questions, and they have been appreciating your explanation as well. We can see in the chat messages. Thank you, sir, for
Okay.
your time, and thank you, participants, for your patient listening. So should we end the session, sir?
Yes. We can wind up this
Okay,
section.
thank you so much, sir. Thank you so much.
Thank you.